Hello and welcome to today's video, Easy Funding Your Hotel. So let's jump right in. So today we're going to learn about what exactly is a hotel. And that might sound a little bit obvious, but I'm going to give you the definition that comes from a lender, how a lender delineates a hotel from other asset classes, who makes these loans, how to qualify, some pro tips, and how you can get started right away if you're interested in buying a hotel or refinancing a hotel. So, what exactly is a hotel from the lender's perspective? Well, the definition of a hotel that we looked up is it's a commercial establishment that provides lodging, meals, and other services to guests, travelers, and tourists. I think the key word there is commercial, and that's in a little bit of a difference to another video that we actually do, which is short-term rentals, or like you would know it as an Airbnb property. And a short-term rental is defined as a rental of any residential home or unit accessory or what have you. So it's basically something that an individual owns and they rent out on a short-term basis versus a hotel, which is considered a commercial property, and therefore the lending is a lot different in the way that they look at it. So who makes these loans? Well, of course, you have your usual suspects. You've got the local, regional, and national banks. And then there's also what we call an SBA preferred lender, which is essentially a bank that has the authority to approve SBA loans without the need for the additional approval from the SBA. And then we're going to talk a little bit about another option, which is small balance commercial lenders, and they typically will lend anywhere between 100,000 up to 2 million. What we're not going to talk about today, and these do relate to hotel financing, but they're really this video is meant to be more for the beginner. So we're not going to get into some of the more nuanced financing options, things for experts that are investors in many hotels, hotel groups, things like that, and those would pertain to bridge financing, mezzanine financing. There's something out there called CPACE, which is commercial property assessed clean energy. It's basically for clean energy properties where they want to make those improvements. We're going to talk a little bit about ground up construction, but that's not the main focus of today's video. There are plenty of good ground up options out there. Again, we can do other videos on those. Preferred equity, that's a whole other, another subject for another day. There's a little thing called an EB-5 program also that you probably may have never heard of. But it's an excellent option for hotel construction in like rural areas. So that's another option we can also talk about in another video. All right, so who makes these loans? Again, the usual suspects, local, regional, national banks. They can typically do either conventional or SBA. So for today's video, I'm going to talk about the local, regional, national banks on the conventional side and what they typically can do, because there's a better way to do an SBA that we're going to talk about in a minute. So if you go to a local, regional, or national bank, typically, if they're going to do a conventional style loan for a hotel, that deal must be extremely strong. We would say it's got to be a 9 out of a 10. So typically, you're going to be putting down anywhere between 30 and 35%. Some strong sponsors can get up to 80% for a refinance, but purchases do typically require more in terms of a down payment, 25, 30, 35%. Several years of operational and ownership experience. So you've got to be experienced in order to qualify for a conventional loan. Excellent personal credit. The deal has to be very strong cash flow. And as a result of the deal being a 9 out of a 10, that rate and term should actually be very attractive. So that is one benefit. If you have a very strong deal, you are somebody that's got some experience, meet all those other criteria, then definitely this may be the way you want to go. You're going to look at probably the best deal in terms of rates that you're going to be able to find. Here's the problem though, and we talk about this in other videos as well. Many banks at the time of this recording, and we've done our homework. We've reached out to multiple local regional banks. I'm based in Charlotte, And I've talked to people all over the country who are saying the same thing, which is a lot of these banks are basically not lending at all, or they're lending very little. They've reached their caps or their ratios. I had a meeting with a prominent bank in our area not too long ago, and they happen to love hospitality. In fact, it's their best product, he told me. And he said, unfortunately for him and for the bank, they have basically stopped lending at all for the remainder of this year. And he doesn't even know if they're going to resume next year, their hospitality lending. So I know that's kind of a universal problem that's happening right now. And it's just tough. It's tough out there with the banks. The other issue is that most hoteliers don't meet this profile. Most of them don't have perfect credit, or they don't have the perfect building cash flowing right now. There's just a lot of things that make it challenging to have that quote unquote perfect file. So let's talk about SBA. SBA is in my opinion, is the best way to do a hotel loan currently, for all the reasons we're gonna talk about and we just talked about. Many banks do offer SBA loans. However, um, the problems we just mentioned, banks aren't in many cases they're not lending. And what I recommend is you go find an SBA preferred lender. It's a totally, well, I won't say it's a totally different animal, but there are actually banks out there, and we work with several that really all they do is lend SBA loans. They work with the SBA. They're a preferred lender. A lot of times they're huge. They're national. Several of ours are in the top 10 in the nation for SBA production. And the other big benefit to working with a preferred lender is they don't have to go to the SBA for the approval. So essentially, they're designated. They have underwriting discretion, and they can approve the SBA loan without having to go get that other approval. And really, what that means to you as the borrower is a bunch of extra time, typically, if they have to go and get that other approval, because then you go basically getting in line with the SBA and wait for them to bless the deal, and then it comes back. So highly recommend you find an SBA preferred lender. So let's talk about the SBA in terms of the two programs that are done with the SBA. There's the SBA 504 and the 7A. I'm going to talk about the 504 first, and I'm going to preface this segment here by saying not all that long ago it used to be that 504s were not rare, but they were more rare than the 7A product. But with the rise in the rates of the 7A, which we're going to talk about a little bit, we're seeing more deals go the route of the 504 rather than the 7A. So I just wanted to kind of explain the differences between the two. You can decide if you're looking at a hotel acquisition or whatever refi, which one's going to make more sense for you. One of the great things, and I think this goes for the 504 and the 7A we're going to talk about, but you can do either a franchised hotel or a flag, quote unquote, or it can also be an independent hotel. Um, these are very versatile. You can use the funds for various purposes, including purchasing, construction, including land, expansion, renovation, and it can also be used for equipment and furnishings. So there's a lot of uses there for the 504 when it comes to a hotel, hotel property. To get a little bit in the weeds here, the SBA 504 works with something called a community development company. You'll hear this term if you go apply for a 504. It's otherwise known as a CDC, and other financial partners, which essentially is a bank in most cases. The project is typically funded at 40% by the CDC, and that's also known as a debenture or debenture. I don't know if I'm saying that correctly, but they fund a 40% piece of the puzzle, and then 50% is funded by a bank typically, and then 10% or 15%. I think it's more like 15% in these, in this environment. But there's going to be an equity injection from you or from your business. And if your business is new, under 2 years old, you may have to pay a larger percentage. That's what I was talking about. So it might be 15, or it could even be 20%. But just know that you're going to be in that zone of anywhere between probably 10 and 20%. Uh, and as I just mentioned, the SBA 504 currently is offering lower rates and higher loan amounts than you're going to find in the alternative, the 7A program. So again, benefits here: lower interest rates than the 7A. And I did a little bit of research right before recording here, and currently the rates are in the 6 to 7% range on the 504, which is a lot different than you're going to find on the 7A. Like I said, lower down payment requirements than your typical conventional. I think we mentioned the conventionals, you're going to typically put in, 25, 30% down, whereas here it's more like 15% down. They offer long-term fixed rate financing used to acquire fixed assets for expansion or modernization. Basically, all that means is you get a long-term fixed rate loan. It's fully amortized without a balloon. Another great benefit of the 504 is it's a long-term loan. And they can go all the way to 15 million in loan amount, and that's for certain circumstances where it makes sense. Terms for the SBA 504 financing are typically 10, 15, 20, or even 25 years. And again, that's going to be a fully amortized and full term loan. Some of the drawbacks, though, on the 504, and this is a fairly big thing to pay attention to. It's a pretty big drawback in a lot of people's eyes. They do require full recourse, which obviously is a personal guarantee, and that goes for anybody owning 20% or more of the operating company and or the real estate entity. They'll be required to give a full unlimited personal guarantee on the loan. Many people don't like that, but it's non-negotiable, and that's the way it goes with I think it's both SBA programs. The other thing with 504 that I think is a bit of a drawback is they typically come with a stiff prepayment penalty. 10-year prepayment is associated with all 504s that are 20 or 25-year terms. So you got a 10-year prepayment penalty. I don't know if that's negotiable in terms of you can get either yield maintenance or like a step down. That's something you definitely want to discuss with your lender, but just be aware that there is a pretty big stiff prepayment penalty on these loans. And it's 5 years if it's a 10-year term loan. So a lot of people don't like that. Here we have just a little bit of a breakdown just to show you kind of the way that they figure out the amounts that you'll get. And I think this is kind of interesting. This is a little bit different than a normal loan. So let's for instance use this example that you're buying some real estate. The price of the real estate is $950,000. You've got an SBA guarantee fee that's going to come with this of $25,000. Typically, there's a bank packaging fee, which is, we'll call it $2,500. Closing cost estimate $22,500, which brings us to a total of $1 million. So that your total cost, and this is where it's a little bit different. A lot of people are used to seeing that $1 million of thinking that's the purchase price, and then you're going to get an 85% loan or an 80% loan against that number, and then you're funding the costs out of pocket. In the way they calculate this, they actually add all that up, and then they start with that top number. So the real estate only costs $950. The rest of the costs put it up to $1 million in total cost. So then we start there. So the conventional loan, remember we said the bank's going to put in 50%, so that's $500,000. The SBA is going to put in 40%, so $400,000, and then you've got your equity injection there from the borrower. So and that's how you get to the total of $1 million. So let's go on to the 7A now. Some of the benefits on the 7A: more flexible, can be used for the purchase of the real estate, can be used for a refinance, can be used for working capital, inventory, business acquisitions, partner buyouts, and even construction. So it's almost like there's nothing that the 7A can't do really when it comes to the whole deal, which is very attractive about the 7A. So the SBA in the 7A program, the SBA guarantees the bank 75%, which is, to me, it's a big incentive for the bank to say yes, or to make the deal work. And it also works for independent properties or franchise properties. So again, those flagged hotels, they work in this program. And also, if it's not a flagged, if just a kind of an independent hotel, you can also get it done in the 7A program. All of the loan processing, which is the packaging, approval, and closing, can be done in-house at the right lender. So the process can be much, much faster than, again, if they're not a preferred lender, they have to go into the SBA for all the approvals and things like that. Another benefit here on the 7A is the prepayment is a little bit softer. It's usually a declining, which is essentially 5% the first year, 3% the second year, and 1% the third year. Oftentimes you do have even a lower down payment, potentially down to 10%, or even lower in some cases. Some of the drawbacks in the 7A, fees are higher than the SBA 504. The loan maximum in this program is only up to 5 million. You do also have, I mentioned before, you also have the personal guarantees. Again, this is going to apply to anybody with 20% ownership. Plus, in some cases, they may ask for additional collateral, like your personal residence, a rental property, a second home. That can be required if it's needed for the deal to get done. And again, a lot of people don't like that, but it's just the way that the SBA is set up to do. But consequently, you can get a lot more deals done because of these factors, because they require the guarantee, and they do so much kind of ensuring that the deal isn't going to go south. I find that a lot more deals actually get done if the borrower is willing to, believes in the deal and is willing to put that guarantee and the additional collateral up if need be. Here is the big drawback, though, unfortunately, with the 7A right now. In today's climate, because of the prime, they use the prime rate as the benchmark. By the way, the 504 does use the prime rate. It uses, I believe, depending on the term of the loan, they use either the 10-year Treasury, or in some cases, I think if it's a 10-year loan, they'll use the 5-year Treasury as the benchmark. And if it's a 20 or 25, they'll use the 10-year Treasury as the benchmark. And that is lower. Currently, it's right around 4.8%. And prime, as you see here, it's currently 8.5%. So that's the starting point. And then, of course, the lender puts on the spread on top of that number. And so, we were just looking at rates a little bit ago. I'm seeing rates even on the variable side of the 7As up above 10. I think it's even up into the teens right now. So it's tough there, and that makes the deals harder to underwrite. Nobody loves those rates being where they are, and we're all hoping that it comes back down. But right now, that's prohibiting a lot of people going with the 7A. As I mentioned before, I think more people are now looking to go to the 504 because of that rate. Because the rates are so much better than where they are now with the 7A. So this is a sort of a summary real quick for either way you go. There are essentially 8 credit requirements that the SBA focuses on, and these are pretty much the same for, I would say, every loan that we look at, but these are specific to the SBA, and just these are the things you want to think about that you need to bring if you're going to go apply for a loan. If you want to buy a hotel, or whatever, if you're trying to get into the hotel world, these are the things you really have to look at before you even find a property, in my opinion. Just make sure that you've got these things figured out. Ability to repay the loan. Now that, by the way, that's going to come from the property itself, in most cases. So they're going to look at the property, what is the income, what's the history, what's the potential, all those things. But that's where they look at the ability to repay. Character and credit history of the business and the principals. So again, make sure that your credit is as buttoned up as it can be. Personal credit matters in these loans. Um, the credit history of the business is important. So if you're looking to refinance something, make sure you're paying the bills, make sure that the thing is performing well. Those are things that are definitely going to be considerations as you go for financing. Um, Obviously, the value of the collateral, how much is the thing worth, um, the business experience of the applicant and its principals. It's not to say that you can't do this with no experience, but I would say your odds of getting something done, like let's say we're going for a 7A loan, a lot of times they're looking at, you don't have to have owned a hotel, but you have to have direct industry experience. So you can't be, a bartender and say, well, you know what, I think I'm going to go buy a hotel. Typically, that doesn't get the deal done. I tell everybody, that I work with, if you're going to try to get one of these things done, you've got to go work in that industry at least. And typically it's about a 2 to 3 year period that they want to see. So go be a manager, go be a hotel manager. If you really want to buy a hotel, that's really what you're going to have to do to get the deal done. And that goes for pretty much any lender out there, I think. Um, if you don't have that, let's say you are just a real estate investor, you find a great option on a hotel, um, you're going to probably need to team up with, i.e., partner up with somebody that does have direct industry experience if you're going for an SBA loan. So just keep that in mind. Make sure you have the requisite experience, or again, find somebody that does and team up with them, work out a deal, and you're much more likely to get this financing done. Um, Review of the equity invested. So again, they're going to look at this. They're going to look at your capability. They may not take all of your money that you have set aside, but you know, the more you can put down, to like, again, if it's an acquisition, if you can put more money down, um, it's gonna enhance or increase the odds of the deal getting done. And that's kind of just it's a bit more of an art than anything else. Um, Perhaps if you're weak in some of these areas, you may have to put a little bit more money down, right? I mean, it's just the way it works. If you're very, very strong and the deal is just simply amazing, then you may have to put less money down. It's not really, there's no real hard and fast rule. Past and future financial statements of the business. So again, how's the business doing? They're going to evaluate the past performance and then the potential for the future. Then they're going to try to analyze the potential for success for the applicant. And again, there's a lot that could go into that. It's more of an art than a science. So they're going to really look at the whole picture, the whole story, and really just make their own assessment of whether or not this is going to be a successful venture, and therefore a successful loan. And of course, they're going to look at the strength of the business itself. So let's talk about another option here that is another option potentially if something doesn't happen to fit with one of the SBA programs we just talked about, and that is a small balance commercial loan. And this one I'm really not going to get too much into the weeds on. And the reason is because there's just no, it's very nuanced, and every different small balance commercial lender out there has their own way of underwriting things. Um, there's like no matrix, there's no pricing sheet I can reference. Every deal is evaluated and priced according to the individual ability to get the thing done. So very high level, broad brush. We've seen these things go as low as 100,000 in loan amount, and as high as 80% loan to value. But I really want to say in this particular realm, small balance commercial, it's way better to just find a professional that has relationships with small balance commercial lenders. I mean, you can go out on Google or something like that, and you'll find some small balance lenders. I think your odds of success are fairly low in trying to do it that way. These are really, like I said, they're very nuanced. You have to know who's interested in making a hotel loan to begin with. A lot of them won't even touch hotel loans. They don't like hospitality. Some of them, they change their guidelines from month to month. So my best advice here is know that it's there. It is a possibility. And if you try those other avenues and they don't happen to work out, this is an area where you may want to look. I mean, again, you might find a better rate here. I know you'll find a better rate here, in fact, than you would with the 7A, for instance. Um, but you're not going to find a lot of the bells and whistles either that a 7A can offer. So it really just boils down to what do you need and kind of, what's going to make the most sense. Um, I will throw this out there. If you do need some assistance here at Capital Connection, I run Capital Connection. Um, we do work with a number of these small balance guys. We know who is and who isn't doing hospitality, and kind of we've got a good grasp on what they will and won't do. So certainly, if you run out of options, give us a call and hopefully we can help you out. All right, on to the pro tips section. And these pro tips came from years and years of me and the team here essentially talking to, getting loans done. We talk to investors all the time. We are investors as well, not in hotels though, although we did almost purchase a hotel about a year ago that we were going to convert to a multifamily. It just never materialized. But anyway, this is what I hear these folks tell me, and I know that it must work. So they tell me they network, they go to local groups. LinkedIn has groups, Facebook has groups. I mean, I think you can probably just Google up a hotel investor networking groups or meetups or what have you. I think that's a great idea and a great tip because, especially if you're new, like I said, you may need to partner up or you may need to get some expertise in a certain area. And I find, the groups I've joined and went to, typically people are, very sharing in those types of environments. So you're going to probably learn a lot, and maybe more importantly, learn what not to do. I don't know, but certainly I think those are great options to explore. Um, I always say this. This is probably the best tip I can give anybody, and that is talk to your lender as early in the process as you can. So many reasons are behind that, but mainly you can't really figure out. You don't know if the deal can even get done. So make sure that you have a viable option to get the deal financed, or that you have the money one way or another to get the deal done. And most people like to leverage. Most people like to borrow from a bank or from a lender. So you might as well figure out what is the lender going to need, because they're going to really drive that process. And that goes to, not only how much is the loan going to cost, but how much of a loan can you actually get? How much will it pencil to? And this is where I think a lot of people get surprised. They they think that this part of the process is the easiest part, and I personally believe it's the hardest part. So, and I know there's a lot that goes into finding a property and getting it all the way there, but really, if you can't get it financed or you don't have enough money to get it closed, then you're wasting all of that time. So my best tip to you is talk to a lender, find a lender, and once you've identified a property, at least get as much information as you can about it, and really go and have that meeting early, and really learn, is this a possibility? And maybe it is, and maybe you're fully ready to do it. But it's better to know that right out of the gate than spend a whole lot of time and then learn later on that you just simply can't get this thing financed anywhere. And it really is just related to a lot of times it's just basically numbers. Um, so another tip here, and this is one I talk about, I think, on a lot of these videos, but it's a great tip because it helps a lot of investors that I've worked with. Actually, I've taken advantage of this program as well. But consider a 0% line of credit, or it's essentially multiple 0% lines of credit. We work with a company, and we were actually affiliated with a company. So, full disclosure, we have a link down below. Go to these guys, check them out. They say they can get up to 250,000 for the right individual, and it's 0%. It's lines of credit, and they work for a lot of real estate investors. So check them out. I highly recommend it. Maybe that helps bridge the gap in trying to get one of these done. So that's my little tip there. And realize, even as I speak, it's October 2023. The world is blowing up all around the world, but believe it or not, we still hear many deals are happening, and it's going on out there. So it's just really a matter of getting the right lender in place, getting the process figured out, finding the deal, and seeing what pencils and what doesn't pencil. And you know, I think I would be still pretty encouraged about what's happening out there. So let's get started. Again, my best advice is if you've got a bank that you work with locally, I think that's your best first bet. Try your local bank or your regional bank or whoever you bank with. Talk to them first. At the very least, you'll get kind of a feel for what's happening out there in the marketplace and what might be available, and they may give you good suggestions as well. So always start with them first. Um, like I mentioned earlier, if you run into a bit of a snag, and don't be surprised if you do. We have access to all the programs here we've discussed in this video. We have many more programs as well. It's all we do here at Capital Connection. We have it, we have that part figured out. So love to help you. There's also should be a link at the underneath this video where you can click and you can just give us some basic information, and we'll doesn't cost you anything. We'll review and see what we might be able to do to help you. Um, and that's just what I just said. So I want to say thank you. Thanks for joining me on the video. Um, Trying to build this channel. We're trying to give you free education, trying to show the world what can be done, teach people how easy this really can be, if they just know a few things, a few basic things. So please subscribe to the channel. Really, really helps us. And let us know if you've got something you'd like us to talk about here. I'd love to hear from you and see if we can put something together. So thank you again. Look forward to seeing you on the next video.